All right, welcome. Today, we're going to tackle a question that's right at the heart of, well, all of business and investing. How do you actually figure out what a company is worth? We're going to break down the three main ways the pros do it. So let's get right into it.
It sounds like a simple question, right? But the answer? It's anything but. See, there's no single magic number. The best way to think about it is that you have three different pairs of glasses, three lenses that you can use to look at the very same company, and each one gives you a different picture of its value. Today, we're going to try on all three.
Okay, so our first lens, this is the one I like to call the intrinsic detective. This approach doesn't really care about the latest stock market hype or what everyone else is saying. No, this detective is all about looking for clues inside the business itself to figure out what it's fundamentally worth.
And the detective's number one tool is something called discounted cash flow, or DCF. Now, the core idea here is actually pretty simple. A company's value is just the total of all the cash it's ever going to make in the future. The only trick is you have to adjust that future cash for the fact that, a dollar today is worth more than a dollar 10 years from now. It's kind of like valuing a rental property. Its value is just all the future rent checks you expect to collect.
To actually pull this off, you need three main things. First, and this is the big one, you have to try and predict all the future cash the company is going to generate. Second, you need what's called a discount rate. Just think of this as a way to account for risk. The riskier a business is, the higher the rate you use, which makes its future cash worth less in today's money. And finally, you have to make a call on how long the company is even going to be around.
And this really gets to the philosophy behind DCF. If you're using this method, you have a fundamental belief that the stock market gets things wrong a lot. You believe the market price can be totally separate from a company's real value. But, and this is key, you also believe that sooner or later the market will wise up and the price will eventually drift towards that true value.
But here's a catch. Believing the market will correct itself is one thing, but that correction could take a really long time, which means the real secret ingredient for any DCF investor is just patience, a long time horizon. You have to be okay with waiting, sometimes for years, for everyone else to see the value you've already spotted.
All right, let's switch gears and put on our second pair of glasses. If DCF is a lone detective digging for clues, this next method, relative valuation, is more like a pollster. Instead of looking inside the company, this approach looks outside and basically asks the crowd, hey, what's everybody else paying for something like this? You see, with this method, you've pretty much given up on finding some deep philosophical intrinsic value. You're just trying to figure out a fair price based on what the market is paying for other similar things right now. The classic example is how you'd price your house. You're not going to do a deep analysis of its future value. You're just going to look at what your neighbor's almost identical house sold for last month. You let the market tell you the price. So how does it work? Well, first you need a standardized metric like the famous PE ratio, price to earnings, so you can compare apples to apples, even with companies of different sizes. Then comes the really tricky part. You have to find comparable companies. Is Tesla really comparable to Ford? Is Netflix comparable to Disney? It's never a perfect match. So that leads to the final step. You have to adjust, or control, for the differences, like if one company is growing way faster or is a lot riskier than the others.
Now think about the philosophy here. It is the complete opposite of DCF. With relative valuation, you're assuming the market is actually pretty smart. You believe that, on average, it prices things correctly. You're just looking for those one-off situations where a single company is priced wrong compared to its peers, and you expect the market to fix that little mistake really, really quickly.
Okay, on to our third and final lens. Now this one's a bit more specialized. It's kind of like the futurist's toolkit. It's used for valuing pure potential, for valuing the big what if. It's called option pricing. This method is designed for assets where the value is completely tied to some future event that may or may not happen. The best analogy? It's like a lottery ticket. Right now, that ticket in your hand is worth, basically nothing. But it holds this huge potential value that's totally dependent on your numbers getting called. It's a massive possible payoff, but only if a very specific thing happens. So where do you actually use this in the real world? Well, think about an oil company with a bunch of undeveloped land. That land isn't making any cash now, but it has value because it gives the company the option to drill if oil prices suddenly skyrocket. Or think of a small biotech startup. It might be losing millions of dollars, but it holds a patent for a new drug. That patent is an option on the drug getting approved, which could make it worth billions. You can even value the stock of a company that's in deep trouble as an option. It's an option on whether they can pull off a successful turnaround. So there you have it. The detective, the pollster, and the futurist. 3 totally different lenses, giving you 3 totally different views of value. The best method to use? Well, it really just depends on who you are as an investor and what you're trying to accomplish.
And this comparison really gets to the heart of the matter, especially between the 2 most common methods. Are you a DCF-type person who thinks the market is emotional and often wrong? And are you patient enough to wait for it to come around? Or are you more of a relative valuation person who trusts the market's collective wisdom and just wants to find those quick little pricing errors? Your whole philosophy determines the lens you choose. So, to sum it all up, DCF is your go-to if you're playing the long game and focusing on a company's deep intrinsic worth. Relative valuation is for when you care about the market's current mood and you're hunting for those fast-moving opportunities. And you pull out option pricing for those unique special situations where the whole story is about what could happen down the road.
So what's the big takeaway from all this? It's that there is no single correct price for any company. Value isn't some fact that you dig up out of the ground. It's a perspective, and it changes completely depending on which lens you're looking through.
And that really leaves us with one final question for you. The next time you see a stock price flashing on your screen, just ask yourself, which story is that price telling me? Is it the detective story, the pollster story, or the futurist story? Which valuation lens are you looking through?